This video is designed to give you more in-depth information about two very simple, easily obtainable insurance products to help protect your financial health. Let's say you're a working professional who's saddled with some student debt. You might make a good living, but you might not have a lot of cash on hand for any short-term emergencies. Your employer could offer disability policies, but have you explored what's available in that policy? Is it short-term or long-term? Do you have a plan in place if you were unable to work for 90 days, 6 months, a year? Bankrate.com released a study showing many Americans are living paycheck to paycheck, with fewer than 1 in 4 having enough savings to cover at least 6 months of expenses. To help lessen this impact of a job loss or medical emergencies, you want to ask yourself, where do you stack up? Think about what disability insurance you have at your disposal. There are two kinds of disability coverage you should know about: long-term and short-term. Just as their name implies, long-term coverage will typically provide benefits until retirement age, somewhere between age 60 and 70, depending on the policy. Keep that in mind, as long-term policies often have a longer waiting period of anywhere from a month to 6 months. Short-term coverage is just that: short. Benefits usually start within 1 to 7 days after your disability, but may only pay until 6 months or a year. Again, this is subjective to the type of policy being offered. Okay, so we've got two kinds to choose from, but how do you know which one is right for you? And this is where you need to compile all the information we've covered to understand what financial wellness is about. Start with your employer or member association. Is anything offered that you're not taking advantage of? Finding out the type of coverage offered is highly encouraged. The average length of disability in the U.S. is 34.6 months long. That means those who have only short-term coverage could face nearly a year-and-a-half deficiency of benefits for the average claim. Next, look at your budget. What can you afford? Then look at what you have saved or as liquid assets. Those who have 6 months to a year's worth of living expenses saved most likely won't need the same amount or even the same type of coverage that a person living paycheck to paycheck might need. Within each of those broad categories of disability insurance, there's a couple coverage options you should know about because it can greatly affect you if you were to file a claim. Own occupation and any occupation coverages can be found in short-term or long-term styles of disability policies. Own occupation means that you are eligible for benefits if you're unable to do your job specifically. Any occupation means that you could end up bagging groceries at your local supermarket just because you can return to work at any job. Now, that's a sizable difference for a trained working professional. Ask about a partial or residual disability benefit with your policy. This rider can help ensure that you receive part or possibly all of your monthly benefit even if you've returned to work. Disability coverage helps protect your income, but what about helping to protect your loved ones if the worst should happen to you? There are two main types of life insurance: permanent life and term life insurance. Permanent life insurance is a lot like buying a house. You can build cash value, you can borrow against it, and if you terminate the policy early without a claim, then you can receive the cash value of the policy. Term life insurance is a lot like renting an apartment because you only pay for the time that you're in it. Permanent life insurance is typically more expensive than term life insurance because of the investment aspect associated with it. I'm often asked, how do you know how much is right for you? How do you know which policy is right for you? Let's look at why you might need coverage and see if that gives us an answer. Common reasons to consider getting life insurance are if you're married, starting a family, making a major purchase like your first home, covering outstanding debt like a mortgage or student loan, or if you want to leave a legacy to family or a favored charitable organization. Results from the 2010 U.S. Census show 69% of all households held some form of debt. During that last census period, there was a 30% increase in the amount of debt held. Debt worries everyone, so you want to find a way to be able to protect yourself. Depending on the amount of debt you have, you might be looking at a higher than average benefit amount. Student loans and housing loans comprise nearly 78% of the debt held by most Americans. Helping to protect your loved ones with life insurance means they won't have to worry about how they're going to pay for the mortgage or care for any outstanding student loans after you are gone. Using term life insurance to get a larger benefit amount for a lower cost may be a great choice in situations like these. Why would a term life policy be a better fit for a married couple starting a family? Let's say this couple was in their 30s and have a baby on the way. They just bought their first home and are living off one income at the moment. Money might be tight, but they know with the new addition on the way, they want to get some sort of coverage in place. To maximize their dollar, term life insurance can give them a higher benefit amount to help ensure their little one will be cared for, and to help pay for the house, and to even possibly support the surviving spouse without breaking their budget. Permanent life would cost more money and provide a smaller benefit amount. Most experts recommend 10 times your annual income to help cover outstanding debts and obligations. You can use a needs-based approach to better suit your budget. What do you need? Calculate your debt and add in the cost of living for your dependents if you are the primary provider in your home. Those factors should give you a ballpark benefit range to explore and see which is the right choice for you. The goal is to meet your needs without being overinsured or breaking your budget. So there you have it, an overview to key aspects of financial wellness. We hope this video series has been informative and helpful. Return at any time to watch this or any other videos in this series. Thanks so much for joining us.